The housing market crash Zillow didn't see coming started in the South, and it's growing fast. Florida leads the nation with 1 in every 267 homes in foreclosure. Austin prices crashed 23% from peak, and Texas builders are offering $51,600 per house just to move inventory. While Zillow predicts 2.6% national price growth and talks about a soft landing, Adam Data, the Texas Real Estate Research Center, and Wolf Street Analysis prove the South is experiencing a full-blown crash that's been quietly spreading for months. But here's what the data reveals that nobody wants to talk about. Cape Coral, Fort Myers, that popular Florida retirement destination, has seen home prices plummet 11% over the past 2 years. And get this, 7.8% of homeowners are now underwater on their mortgages. That's the highest rate in the entire country, according to recent analysis. Have you noticed this in your area? Because if you're anywhere in the South, you're about to. Now, I'm going to show you exactly which 5 markets are collapsing the fastest, why every major real estate company completely missed this crash, what the massive investor exodus really means for prices, and the 3 warning signs that tell you if your market is next. But first, let me explain why Cape Coral is just the tip of the iceberg. The inventory explosion in Southwest Florida tells the real story. We're talking about 14,580 homes currently listed compared to just 5,586 last year. That's a staggering 160% increase. And here's the kicker, 52% of all listings have undergone price cuts. When over half the homes for sale have already been marked down and sellers still can't find buyers, that's not a market correction, that's a crash. But here's what's really disturbing about this whole situation. While Cape Coral drowns in inventory, foreclosure actions exceeded 100 in May 2024, up 50% from April and 60% year over year. The market has shifted to 7.3 months of inventory, which puts it firmly in buyer's market territory. And that insurance crisis everyone's talking about? Annual premiums now average over $11,000, the highest in the nation, forcing owners to list properties they simply can't afford to maintain anymore. But here's what the data reveals about the broader Florida market that's even worse. Statewide, median home prices are down 4.3% year over year, according to Zillow's latest data. That's the largest decline since 2011. Single-family homes dropped to a median of $412,734, while condos crashed 6% year over year. The Florida Realtors Association reports active listings have surged to 226,600 homes, pushing the months of supply to 6 months statewide. Now let me ask you this, have you noticed more for sale signs in your neighborhood lately? Because 30.7% of all Florida homes are now experiencing price reductions. And the median days on market has stretched to 70 days. That's 13 days longer than last year. When nearly 1 in 3 sellers has to cut their price and homes sit on the market for over 2 months, you're looking at a market in serious distress. But before we show you which markets are seeing the most dramatic crashes, let me tell you about something that should terrify every investor and homeowner in the South. Here are the 3 Texas markets showing the most severe corrections, and the numbers are absolutely staggering. First up, Austin, where home prices have crashed 23% from their June 2022 peak through May 2025. Active listings have reached 13,105 in June 2025. That's up 20% year over year and 70% compared to 2019 levels. The active minus pending gap has reached 12,600 homes, the highest in over 20 years, while 28% of listings have undergone price reductions. Second, Dallas-Fort Worth, where we're seeing 30,998 active listings representing a 67% year-over-year surge, the highest inventory level in a decade. This market transformed from just 1 month of supply in 2022 to 3.5 months currently. Sale volume has declined 2.51% year-over-year, while 30% of all DFW listings have experienced price reductions. Third, the statewide Texas builder panic, where Lennar disclosed average incentive costs of $47,100 per house nationally, but in Texas markets, it's hitting $51,600 per house. That's 16.9% of the sales price. D.R. Horton's gross margins have declined from 24 to 21.8%, as over 80% of buyers using their mortgage company accepted rate buydowns. But here's what the data reveals that's absolutely shocking. The Texas Real Estate Research Center reports that over 70% of closed sales in Q1 2025 included price cuts of $5,000 or more, the highest rate since Q1 2011, when foreclosures dominated the market. When 7 out of 10 buyers are negotiating thousands off the asking price, you're not looking at a healthy market adjustment. You're witnessing a collapse. Have you noticed builders in your area suddenly offering massive incentives? Because this isn't happening in isolation. America's largest home builder just admitted that the trend is still pointing towards a bit higher incentives, and they're not talking about small discounts here. But before we reveal which other southern states are showing the same warning sign, please take 2 seconds to help me out and hit the like and subscribe if you find this video interesting so far. Each like, subscribe, and share helps support this channel and keeps us motivated to keep making you great content. Thank you. Now, let me explain why institutional investors are abandoning these markets faster than you can say fire sale. The Institutional Investor Retreat tells us everything we need to know about where this market is heading. CoreLogic data reveals investor market share peaked at nearly 30% in January 2025 before plummeting to 23% by June. Major players like Invitation Homes became net sellers, offloading 378 homes while acquiring only 276 in Q2 2023. That's 3 consecutive quarters of portfolio reduction. But here's what the data reveals about the iBuyer collapse that nobody saw coming. Opendoor purchased just 14,684 homes in 2024, down 58% from 35,000 in 2022. The company laid off 17% of its workforce in November 2024, and their stock price is hovering around $1, facing potential New York Stock Exchange delisting. OfferPad shows similar distress with only 245 homes under contract, and a New York Stock Exchange non-compliance notice for falling below the $50 million market cap threshold. Florida markets show the most dramatic investor pullback. Orlando experienced a 27.5% year-over-year decline in investor purchases, Miami down 21.3%, West Palm Beach falling 14.5%. When the smart money runs this fast from a market, you know something's seriously wrong. Cash purchases, a proxy for investor activity, have declined across all major Florida metros, reaching a 3-year low of 32.6% nationally. Have you wondered why these billion-dollar companies with teams of analysts are suddenly retreating from markets they were aggressively buying just 2 years ago? Because they see what's coming next. But before we show you the warning signs that tell you if your market is about to crash, let me reveal something that should send chills down every homeowner's spine in the Southwest. The Carolinas are showing the exact same distress patterns, and it's spreading fast. North Carolina's statewide sales volume dropped 10.8% in August 2024, while inventory surged 12.9% to 53,008 listings. The percentage of homes with price reductions jumped to 34.7% from 27% last year, while only 20.5% of homes sell above list price, down 5.8 percentage points year over year. Charlotte's market shows particular weakness with inventory up 27.2% year over year. Days on market extending from 43 to 54 days, and closed sales declining 9.8% in February 2025. Durham saw median prices drop 0.9% year over year, with days on market increasing 122.2%. When a research triangle market starts showing price declines, you know the correction has reached stable, educated markets. But here's what the data reveals about South Carolina that's even more concerning. Sales volume declined 8.7% year over year, while inventory grew 16.9% to 31,038 homes. Charleston's market has completely stalled with 0% price growth in 2025 after years of double-digit increases, while 35.4% of Charleston County listings have undergone price reductions. Tennessee and Alabama complete the Southeast disaster picture. Tennessee's inventory surged 16.3% to 17.5% year over year, with 24.2% to 30.8% of homes experiencing price drops, well above the national average of 23.8%. Nashville's inventory exploded 29% year over year, with sales volume down 18%. Alabama witnessed an 18% drop in home sales in 2024, the lowest transaction levels in recent years. Have you noticed how these markets all show the same pattern? Exploding inventory, declining sales, and widespread price reductions. This isn't a coincidence, it's contagion. But here's what the data reveals that should terrify anyone thinking about buying or selling in these markets. Contract cancellations have reached crisis levels, with 14.3% of pending home sales falling through in January 2025. The highest rate for this time of year since at least 2017. Atlanta leads the nation with a stunning 19.8% cancellation rate, followed by Orlando at 18.2%, Houston at 17.8%, and Jacksonville at 17.8%. When nearly 1 in 5 buyers walks away from signed contracts, you're looking at a market where confidence has completely collapsed. Florida agents report that increased supply gives buyers license to be fickle. When inspection issues arise, buyers simply walk away knowing abundant alternatives exist. But here's what they're not telling you. This surge in failed transactions indicates fundamental market weakness as buyers lose confidence in valuations. Foreclosure activity reveals the true depth of southern market distress. Florida leads the nation at 1 in every 267 housing units experiencing foreclosure filings in 2024. Lakeland, Florida tops all metros with 1 in every 172 homes in foreclosure, while Columbia, South Carolina ranks third at 1 in 204. Adam Data's Q1 2025 report shows foreclosure starts up 14% and bank repossessions rising 8%. But here's what the data reveals about builder desperation that nobody wants to discuss. D.R. Horton reports over 80% of buyers accepting mortgage rate buydowns, while Lennar's incentives reached $81,700 per house in Florida markets. That's 13.4% of sales price. When builders have to pay buyers to purchase their homes, you're not looking at a healthy market. Have you wondered why your local builder is suddenly offering to pay your closing costs, buy down your rate, and throw in upgrades? Because they're sitting on massive inventory they can't move at current prices. But before I reveal the 3 warning signs that tell you if your market is next, let me explain why national averages are completely hiding this regional catastrophe. While the National Association of Realtors forecasts 2% home price growth for 2025 and CoreLogic projects 4.1% appreciation, the South tells a radically different story. Over 55% of all U.S. homes for sale are located in southern states, despite comprising only 38% of the population. The South accounts for 54.8% of all housing starts, yet shows the highest foreclosure rates, most dramatic inventory buildups, and steepest price corrections. But here's what the data reveals about this disconnect that nobody wants to acknowledge. When Zillow's CEO describes buyers gaining more balance, they fail to mention that this balance means actual price declines across multiple southern metros. When Redfin says the days of overpricing and multiple offers are gone, they dramatically understate the reality of 70% of Texas transactions, including price cuts. The geographic concentration of distress makes national averages meaningless for understanding what's really happening. Federal Reserve Bank research confirms housing affordability has reached crisis levels, with multiple Fed districts reporting critical conditions, yet national reports continue promoting stability narratives that obscure regional collapse. Here are the 3 warning signs that tell you if your market is about to experience what the South is going through right now. First, inventory growth exceeding 20% year over year, combined with declining sales volume. When supply surges while demand falls, prices must follow. Second, price reduction percentages above 30% of listings, combined with days on market increasing by more than 10 days year over year. This indicates seller capitulation is beginning. Third, contract cancellation rates above 15%, combined with declining cash purchase percentages. This shows buyer confidence is evaporating and investor interest is waning. Have you seen these warning signs in your market? Because if you have, you're looking at the early stages of what Cape Coral, Austin, and Charleston are experiencing right now. But here's what the data reveals that changes everything for both buyers and investors going forward. The southern housing market crash isn't coming. It's already here. From Florida's nation-leading foreclosure rates and underwater mortgages to Texas's 23% price crashes, from the Carolinas' collapsing sales volumes to investor abandonment across the entire region, every meaningful metric points to a market in freefall. While national averages and corporate narratives promote soft landing scenarios, the reality for millions of southern homeowners is dramatically different. Falling prices, surging inventory, extended selling times, and the highest foreclosure rate since the last housing crisis. The housing market crash started in the South, it's spreading to other regions, and based on every indicator we've shown you, it's accelerating. It's not speculation. This is documented fact from authoritative sources including Atom Data, CoreLogic, the Texas Real Estate Research Center, and major MLS systems across the South. The disconnect between what major real estate companies are telling the public and what's actually happening on the ground represents one of the most significant misreadings of market conditions since 2008. The question isn't whether this crash is real. The data proves it is. The question is how fast it spreads to other regions and how deep it goes. Based on everything we've shown you today, we're just getting started. If you found this video interesting, please subscribe, share, and watch this one as well.